Would you put your hands up, please, if you can hear me? Thank you very much. Anybody who's really cutting it fine to log on, and then we'll start. Brilliant, if you can all hear me. Just bear a couple of minutes and then we'll get cracking. All right? This evening. So welcome again, guys. Thank you for logging on. Hope you've been having a very productive day with your self-managed learning. In the chat panel with me, I have the wonderful Christian Patworth, who is to be assisting with your queries as we go through. So if you have any queries as I'm going along, please type them in. Christian's going to hopefully answer all of them. If I can see any, I'll try and answer a couple of them as well. But he's going to be helping you with those throughout the session. So hopefully you have all downloaded and printed off your online tutorial 1 workbook. So we're going to be working through this evening. And what I'm going to do now I'll just share my desktop with you so that you can all see what's going on. Just one second. Just one second, guys. It's just not letting me share my desktop. There. Well, I'm able to see my screen now. Open to our online tutorial workbook then. This evening, what we're going to go through is a couple of things that you've seen through your SML already, and we're going to focus in now on essentially a couple of things from an exam technique perspective. So have a look first of all at property, plant and equipment, then at some leases, then on provisions, and then a little on revenue recognition. So hopefully, as you've been going through, you've been now realising, along with sort of your RS book that you've got, that all of these have got their own sort of each one on here for you. I have a couple of email queries today. Do you need to learn the standard? I just thought this was worth mentioning to you. Essentially, there will be no marks in the exam for mentioning the names of the standards. However, it might just kind of, particularly in the explain question, give you a little bit of credibility. So the contents page of the IFRS book will help you with the standards, names, etc. But I wouldn't spend time learning those names. It's much more important that you learn the rules within the standard rather than the title of the standard itself. Into the book given for this tutorial, so what we're going to do is we're just going to have a chat through what is in IAS 16 and which is in the disclosure note section. So the disclosure note is going to be essentially behind the financial statement. So behind your income statement, behind your statement of financial position, behind cash flow statement, statement of changes in equity, we're going to have these notes which essentially are just breaking down the figures on the front of the statement so that we can see things in a little bit more detail. So the self-managed learning has run me through this hopefully, and you should therefore be quite happy with the layout of the notes. The note splits itself down into three different sections. So the first section is about cost. So the cost section, we've got anything that we have added, anything that we have disposed of, and those kind of ideas we saw when we had a go at our certificate level paper. We were able to add assets in and calculate, using that disposals count, the disposal gain or loss, and look at where it sort of fitted into the full calculation. What is new at FAR is the idea of revaluations and held for sale, and that's what we're going to have a look at in a little bit more detail shortly with a question, so that we can just emphasise the aspects that you maybe are a little bit more kind of uncertain of at the moment. So hopefully we'll clear some questions on that up for you. And the second section then is the depreciation section. So depreciation is going to involve essentially always, so always have our income statement charge fitting into the note. And if we've had a disposal or a revaluation or a held for sale or an impairment, that might feature as well. And we're going to, again, the question, just see the sorts of things that the examiner will be kind of including within the question and within the exam, and get you a little bit more comfortable with how that works. 1 minus 2 is sort of equals 3. So what we've got in the third section is the carrying amount, so where we've taken the cost minus the accumulated depreciation to essentially what we will see on the statement of financial position. So the idea is you get hold of your financial statements, have a look at what the PP&E amount you've got, and you turn to this note and you just get a little bit more of a feel for what is it made up of, what classes of assets do we have, so in this case land and buildings, plant machinery, other things that we might see in here, maybe fixtures, fittings, we could fittings, and one which is a little bit unusual, but the examiner does quite often pick up on this, is the idea of having an asset under construction, and we'll come back to that idea as well. We're going to see that shortly in the question we're just going to do together. So that is the disclosure note itself. The thing that the examiner is going to do then in FAR, and just to kind of start warming you up really for FAR as a paper, get in the FAR exam is a prepare, revise the statement question. That's going to be similar to the long question that we at certificate level. We're going to get a cash flow statement. What we saw in September was a very short question on cash flows, only 11 marks. What we saw in December was a 17-mark question. So the examiner is kind of giving the impression at the moment that your maximum going to be around 20 marks on cash flow statement. That's in line with the question bank from last year. We haven't yet got this year's question bank. But last year's question bank showed cash flow statements around that. Your group question. Okay, this question is going to be probably a consolidated SSP and a consolidated income statement, so either or actually. And groups is something that you're going to cover at the very end of the SML. Or if you're sort of thinking, what are these groups of that before, that's going to be covered at the end of self-managed learning. Have an explain question. I remember going back to what we saw on Monday on the onboarding, it's 4 to 5 questions. So essentially you could then have a bit of a kind of surprise question really, but there's a definite potential for it to be an extract question. And this is the sort of question that we're going to attempt together tonight. So tonight we're going to have a look at a PP&E extract question. You sort of a different focus from the sort of standard prepared statement question, which hopefully from certificate level you are a little bit more comfortable with. That question is what's going to form the basis of the first bit of the session this evening. Let's go into that question then. So if we go back to the workbook, I want you to turn over the page. So this is actually an old financial accounting question, but we know that financial accounting forms a big basis of FAR, and therefore something like this would definitely be potentially in the exam, and we want to make sure you're nice and prepared for it. So what I want you to do is just to sort of have a look or just have a read through the question first of all. So you may have already done this, so apologies if you're sort of going to twiddle your thumbs now for a minute or so, but I'd just like you to have a good read through it For yourself, develop a few expectations from the SML. I'll give you sort of 2 minutes to do that. And together what we're going to do is read the question and have a think about some of the things that we can see in here. Okay, so have a go, 2 minutes, have a read, and I'll be back with you in a couple of minutes. Okay, so hopefully that's given you time to have a good read of that just for yourselves. So now we can go through together and really start to just have a good look at this question, and then we'll have a look at some exam technique before we really start having a go at the nitty-gritty of it. So your first read through of the question, it's important that this is not a kind of a skim read. It's not going at 1,000 miles an hour. It's calm, it's considered. And you're able to take in a lot of the detail that the examiner is providing you. So bear in mind, and this is a lot of times what students forget, the examiner actually spends months and months and months writing these questions. The wording of them is thought about very carefully, and therefore you are almost needing to read them as slowly as you can. Bear in mind it's an exam and you will be feeling the pressure, but you have to kind of try and rein it in and make sure your read of the question is really, really nice and focused. So going through this question first of all, examiner, quite common for them to mention or kind of introduce the company. It's irrelevant really that we're an engineering company, but what's not irrelevant is that we've got a significant amount of PPE. So once we've kind of read the first line of the question, what I would be saying you then really want to do is turn to the end of the question and have a look at what the examiner actually wants us to do. So we read the requirements first, to then read the question with a clear picture of where the examiner is going with this, why are they giving me X amount of information, what is my end sort of focus. Otherwise, what we tend to see happening is students just panicking. By the end of the time, they've read the question, they read the requirement, they're having to reread the question, panic's rising, and it's just not a very focused approach. So try to read the requirement first as possible, really. One thing I'm going to do here, just because I want to develop this slightly further than we've got in the workbook, I just want you to add a part B here. going to do is just talk through a little bit extra on revaluation. So can you please add to your workbook a pie that says set out how the loss identified in note 3 i.e. how much impairment written this down now, hopefully, and we've read that we're going to have to prepare a note for PPE. So in our mind, we're starting to develop that expectation. We also then that we're going to have to deal with some form of impairment. As we go through the question now, we are considering throughout what sort of things are in here, how is that going to impact the property equipment note, but also how that's going to impact the overall impairment that we are dealing with. Okay, so returning to the previous screen now, company, we've got significant amount of property, plant and equipment, so it makes sense that we are doing a PP&E note. And the first thing that the examiner does is says that financial statements for the year ended 2006 included the following balances in respect of property, plant and equipment. Now, cast your mind back to certificate level accounting, and you're probably going to remember how important dates were to the examiner. So one of the main ways the examiner just opens up the trap and lets lots of students just pour into it is by putting funny dates in there so that they hopefully will trip you and maybe just confuse you a little bit. We want to avoid that as much as we possibly can. So from the requirement, what I would do at the top of the question is just write, looking at my requirement, I know that I'm dealing with the year ended the 3rd of September 2007, and then when they tell me it's from 2006, I immediately know that's my prior year, and therefore here are my brought forward figures. Okay, so you're paying lots of attention to dates, particularly in a property, plant and equipment question where things like depreciation are a minefield when it comes to dates. We'll be nice and clear about where we're going with the question. So there's our brought forward balances. Let's see what the examiner wants us to see. So they adopt the cost model for assets with the exception of land and buildings. So what we do now is just make a note. That's going to be the cost model. That will be the revaluation model. So I'm annotating my question and making my life easier by taking some of the narrative and just drawing on the question, basically, bringing things to my attention and flagging things that I know I'm going to have to deal with later. The question mentions then here is that we do make an annual transfer between the revaluation surplus and retained earnings. Now, seeing the annual transfer in your self-managed learning, the question will specify whether you do or do not do the annual transfer. If the question is silent on the matter, given it is best practice under IAS 16, then you will know that, or you will essentially be awarded marks if the question is silent for doing the annual transfer regardless. What you mustn't do is if the question says, for example here, if it said Brad does not choose to make annual transfer, you don't want to waste time doing the annual transfer, as essentially you won't pick up any credit for it. Annual transfer we're going to think about later, and that is really going to feed into our part B, okay, when we work out how much the impairment can go through into the income statement. The additional information we've got here then. So we've got land is reflected at a valuation of 850,000. That means we need to make sure that we charge no depreciation on that. All the items of property, plant and equipment are just depreciated on a line basis as follows. So we've got 50 years for buildings, plant and machinery, office equipment. And what I would just do in the margin here then is make a little note for yourself of what each paragraph of additional information is actually talking about. So this paragraph is all about depreciation. Depreciation, as we're going to see shortly, is going to be something you're going to deal with last. Okay, so but make a little note that that's what that's about. Moving on to the next paragraph. So on the 31st of March 2007, PLC purchased plant at a cost of 130,000. So that's going to be our addition. And they sold for a bit a machine that cost 104,000. So that is going to be our disposal. In October, it was that classified as held for sale. So we need to factor that held for sale classification in terms of when did we depreciate. So in terms of depreciation, we need to think how long overall had the asset been depreciated for. And the final bit here, probably the bit that's a little bit unusual and you'd want to be looking out for something like this, started to self-construct a specialised turning machine. And that basically means we've got an asset under construction. As we're going to see shortly, the asset under construction has to have its own column in the PP&E note. September 2007, the next paragraph, we noticed some cracks. Now, cracks are going to be an impairment indicator. So an impairment indicator is going to therefore trigger your impairment review, and review we're comparing carrying value versus recoverable amounts. And I'm not suggesting that you write all of this on the paper, that you'd be able to do all of this in the exam, but what I'm trying to show you is the kind of thought process you should be going through when you're reading the question. So you're analysing it, you're breaking it down, and you can then start to think about what order to attempt things. So those are the kind of thoughts and the kind of narrative triggers that you should be looking for within the question itself. Page then, so top of page, we're told that the foundations are insufficient. We're then told about what the workshop had cost. So that's going to feed into the carrying value, but we're going to have to calculate what the carrying value is at this point. It's estimated that their value is 100 grand and the cost of sale would be 5,000 and the value in use has been estimated at 90,000. Okay, so essentially these are all kind of things which are giving us our recoverable amount, and we'll see that coming back. So overall, this paragraph, all impairments, we'll see how we're going to deal with that shortly. Final paragraph we've got then, the first 2007, the directors decide to sell a major piece of machinery. So make that decision to sell on the 1st of August. We've identified a buyer, selling cost expected to be 1,500 and the machine cost 50,000. So this is a held for sale asset, and essentially then with the held for sale asset, we're going to have to think through those rules of lower of cost and net realisable value, etc., etc. So I'm going to come back to the kind of rules. What I want to do now we've done this is think about the approach. So in the question in this way, breaking it down and thinking about what I've got in each paragraph and what kind of technical issues is the examiner throwing at me, and apply exam technique really nicely. So as I mentioned, you've got to read the requirement first. After you've done that, you need to do a very detailed read of the question. So just as we've done together, marking up the paper, try to make your life easier by clocking the key dates, writing or making a note of the key technical knowledge that's going to be required, and really just stepping into the world that the examiner has actually created for you. Because believe it or not, as I say, they do spend months writing these questions. Next, you're going to draw out the pro forma, and that's been done for us actually on this next page. So we're not going to have to do that this evening. But in the exam, you'd have a blank answer booklet, and essentially that would mean that you need to know the pro forma. Now, randomly, the P&E note in 12. Now, IAS 12 is an income tax. So make sure you ignore tax rules, but if you do want to have a little prompt for what the PP&E note looks like, it's there actually with deferred tax, which is an advanced stage subject. It's there, you can actually find that and use it. So it is there, it's just not in IAS 16, which is why a little bit of the formatting of it is left up to the preparer of the financial statements, because there's no strict rules as we have with IAS 1 and the pro formas for the rest of the statement. I'm going to work through the easy numbers first, and this is where the detailed read has prepared you to do that. So I know where the brought forward balances are in the question, we know where the additions are in the question, and we know where the disposals are in the question. Essentially, when you're doing this, you need to prioritise what you're doing. The exam is incredibly time pressured, and you will be, by the course, hopefully, but by the exam definitely, we will have hammered into you how important it is to stick that 1.8 minutes a mark. But even so, even the best prepared student will usually have one question that, you know, you've run over 2 or 3 minutes and you're slightly down on your time. So very important that throughout you are prioritising the easy marks first. The only reason that a well-prepared student will fail the FAR exam is by trying to be too clever, essentially. So you do want to make sure that when you're going through easy things first, build up to the more tougher things. So the tougher things and the harder marks are definitely the sale asset, action. Depreciation you must do last, okay? Because essentially it isn't until you've dealt with everything that you will really be able to do the depreciation calculation quickly and efficiently. You also must make sure that you read the whole question. There's a few examples in the FAR bank where you have got a depreciation policy in note 1 of the question, which changes by note 4, let's say, and people jump on the bandwagon, calculate depreciation, and get to the end of the question, not having followed the technique essentially of doing the detailed read, and they've done all these calculations which are then wrong, and you're penalising yourself essentially if you do that, because you'll just waste time. So you must make sure things like depreciation and the impairment, held for sale, they're the technical things. We want you to do them. We want you to do them really well, but we want you to do them after you've dealt with the easier numbers first. Transferring your workings as you go. So there was criticism in the past of students, you know, they've been asked to prepare a PP&E note, and what the examiner gets is a blank pro forma and a whole sheet of workings behind. As you calculate something, transpose it onto the PP note. And more important than anything else, you've got to stick to time. I know that a lot of you are asking about the question banks. The question banks have not been published yet for FAR, that's why they weren't in your material, but there is also a limited number of questions for you to attempt based on it being a new exam. Once you start attempting the questions, then what you mustn't do is spend a long time doing each question, getting it perfect, because essentially you are not working within the time frames of the exam. The exam will be ridiculously difficult to do in time. The ACA written papers in general are like that, and there is nothing more important than making sure all questions are attempted and times are maintained. So the quicker you can get through that, or that you can get comfortable with that, I'm afraid perfection is going out the window slightly, the better you will do, and the easier you will find things overall. Stuck into this question, actually start seeing the the numbers coming through and exactly what we would need to be doing. So we're going to start first of all we've read, we've done the detailed read, we've pro forma done for us. Start with the easy marks first. So the marks in this question, essentially we want to be looking for our additions, we were looking for our decimals as well. So we got in there, so we've mentioned that we had, or we've got £135,000 of plant and machines. We've got 56,500 of and we've got 29,200 of assets under construction. And wondering where I'm pulling all those numbers from, I'm taking them from that detailed review we did. They were in paragraph 2 essentially. So there is our 1.5, there is 6,500, and there is our 2,200. So let me just have those up so you can definitely see where they're coming from. Those are our additions. They need to go in first. They're all coming from additional information point. And what we want to do then is, assuming we have produced this wonderful pro forma, which I'm very grateful someone has done for me, we're then going to slot into the pro forma the additions and start with plant machinery. So we want 1, 3 plant and machine. In here, 29,200 in assets under construction. Assets under construction, if any of you are wondering, this gets its own column. Complete start depreciating. So charge any depreciation on an asset under construction. So straight away we can pretty much just blank out all of this because there'll be no depreciation on our asset under construction. Well, definitely getting those brought forward marks as well. So the brought forward marks are definitely going to be some of the easiest ones. And all we need to do with those is lift those out of the question as well. So we mentioned, or we highlighted them before, Klarna had given us them. So all of these numbers here, they need to go into the first section. So section 1 of the note, section 2 of the notes as well. So let's just go back and do that as well, okay? second just while some of you. Sit, I will thank you, Vera. Thought that quickly, just put those back in a thinner pen, because then that isn't very clear, is it? Sorry. Thank you for saying, because otherwise it's difficult for me to know. Classroom, no, so nice to have some feedback. Thank you. Thank you. Sorry, thank you for telling me to do that. Right, so we've done our brought forward. We have done additions. Those two. Just make it this bit. So the disposal. So again, the disposal was in numbered or. We do two things when we have a disposal then. We deduct the cost of the asset. Also need to add back the depreciation, because essentially what's happening when we dispose of our assets, we are crediting cost. So cost, everything accumulated. So essentially go opposite in terms of the cost of the asset, so we've got less accumulated depreciation. And that's what we're going to see when we go through the debiting cash with the proceeds and debiting or crediting and all the loss. Okay. With the disposal, first thing we want to do is deduct the cost. So the asset, we are told, question was 104,000. We also want to add back it is depreciation. So essentially, what we need to work out now is how many or how much depreciation have we actually got. We've had this asset, and we can see from the question, from 1st of October 2004 till the 31st of March 2007. Somebody brave in the chat panel, how many months is that? So months we've got 30 months. Yes, Shenty. Well done, Shenty. So we've got 30 months. think about. Been charging depreciation 104,000 times 30 months. Oh, we know depreciate machinery for 25% rate line. So 25% line essentially the same as saying we're depreciating it for 4 years. So we charge depreciation for 4 times 12 months, 48 months in total. Depreciation that would be is 5,000. So we've got 2 things to do then. We need to deduct the cost and we need to take out the accumulated depreciation or see it as it being added back. So we go through to our pro forma. We deduct the machinery to go through for sale column, because essentially we have this we were told in question on the 1st of October as held for sale. So it's going in the held for sale column and the depreciation on it is going out of. So the next thing that we need to deal with going back through to our workings, we now need to start thinking about cycle and sale. That we want to think about, or the first thing I would personally deal with, is the held for sale. So let's get cracking on that one. With for sale then, we've got 2 things that we need to do. To deduct 50,000 then we need to make sure that we add the depreciation for the year date of creation. Question in the final point, in point 4, on the 1st of August, then we held for sale. So let's work out then how many months in the year that actually gives us a depreciation. So we know it's going to be 50,000 at 5% straight line. But let's just test you guys out again. How many months then of the year is it before we classify it as held for sale? Is it going to be fastest finger first? Very good, very good. Right, so correct. So going to be looking at 10 months before it is held for sale. And that means then we've got 10,417, and that we're going to use in the final calculation. We need to do then, and we need to think about recognizing any impairment the held for sale classification, and this is the main rule you will have seen as part of the self-managed learning. So we classify as held for sale, we need to make sure that we're holding at the lower operating value and fair value less cost to sell. Now, the question, essentially, they've given us fair value less cost to sell clearly, and it was 11,100. So less cost to sell is 9,500. So we're asking ourselves then, is carrying value going to be lower? Let's work out carrying value. We know that the cost is 50,000. We know that accumulated depreciation then going to be calculated on, similar to the one we've just seen, it's going to be 25% equals 4 years. So 4 years time, which is 48 months. So how many months have we owned this asset until it is classified for sale? It was bought first on the 1st of August 2007. Anybody be faster than Shenty? Is there anyone else out there? Well, thank you for trying. You just won. So it's 30 again. Brilliant. End up with accumulated depreciation 31,250. Value is 18,750. That is exceeding cost to sell. If that happens, what do you get? What do we get? And loss, but Debira. So an impairment loss is going to arise now. Impairment loss, therefore, is going to be between are 18,750 and 1,500, and that would be 9,250. And so we know that 9,250, that's going to go in your new note. Impairment, one partner that I worked with when I was in your shoes told me that always to think of impairments as they're just accelerated. And when we recognise an impairment, we basically just do the same. You can call this impairment expense if you want to, but we basically just do exactly the same double entry as we do when we record depreciation. As I mentioned before, let's not save this working until later. Let's put it to our PP&E note then. So if you go on to your workbook, in the plant and machinery column, in 1,250, you should be able to see that going through. Okay, something happened with my option. So just while I sort this out, you can put the impairment into the into the plant and machinery column. I reckon, sorry, it's just messing around. Second, the computer's not easy for some reason. Right, back on now. Right, we're back in. So hopefully already you've gone ahead and popped that into, so the impairment of 9,250. Ooh, let's make that thin. We need to deduct the cost. I just realised, sorry, before this 104,000 should be up here, although it was for sale during the year, we disposed of it by the year end, so that 104,000 should be up there, and the 50,000 is going in here. Sorry, just thrown off. My computer is causing issues, so no technical issues, I promise. So we have deducted out the cost for the sale as well. And the final thing we need to do, this is the funny thing that students don't like. So particularly this bit, can I say absolutely? Okay, me now, can you see my something very funny going with my computer. I can now, Anna, they found the impairment note for tough. Okay. Would we go back through the impairment again? We want to go back through the impairment again. Okay, let's read. Have you all just changed that slower, okay? Thank you. Thank you for the feedback. How move that number, so the disposal, 104 through disposal and the 50,000 through held for sale. Just make that and then we'll go back to the impairment. Yes, good. Nice. Okay, go back to the harder marks then. Sorry, the computer is not helping. I'm trying to the computer by going faster, but I will slow down, I promise. Right. So, marks. The harder marks are going to come from the held for sale, the impairment. Right, deal with the first. The thing that you want to do is to deduct the machinery. Is that so on that? Right, we all hopefully. So firstly we deduct the cost. Secondly, is we are going to work out the deduction we classified what we have got the 30th of September. Classified this asset for held for sale on 2007. Creating has got a cost is 25% of my base. And what happens in the year where we were depreciating? So 2007, 1,417. That form part of the depreciation charge for 2007. Park that for a moment. When we count depreciation later in the question, but we will need it in a second, so we just wanted to work it out now. Then is the impairment. So the main rule for assets the date of classification be measured lower carrying value cost of sale. We go back to the question. It's in point 4. Essentially, what we've got here then is we've got the value of 1,000 of 1,500. So both of these together cost for sale. Cost to sell that we're slotting into our working now is a fair value of 11,500. We've cost to sell 11,000. Cost of 1,500. Overall fair value less cost to sell 500. So we need to think about, is carrying value lower or higher? To get to the carrying value, we need the cost, which is 1,000. We need the accumulated depreciation, to for sale. So the period is from the 1st of February to 5 till the August to 7, which I mentioned before, comes out 30 months. multiply the cost of the asset by and by and months here. 28, based on the fact that 25% strain depreciation estimating years, we then apply 4 years to get the total number of months that is useful economic life of the asset. So depreciation that we would have touched on this asset 2000 is 750. Sometimes by 25%, but essentially often in the exam, if you're trying to prorate things by the number of months, it's much easier to convert the number of months, the percentage into years, and convert those years into months to make it easier. Okay? Most of the time, manual and some of the examples. So if any of you had a go at the plover question, and the plover question in the manual, they say depreciate at 2%, and then in the back of the book they're using 50 years. Essentially, same idea, 2%, same as saying 50 years. So often you will find it's much easier to equate a percentage to a period in time instead of a percentage term. Beastly, yeah. Is everyone following that up to there? Yeah. Couple more questions. I don't want to go further. Yeah, happy here. Good. Good. Auntie's happy. In terms of how to equate the percentages to years, well, you've just got to think about how much the percentage is divided by. If you think about 25%, so then, or as of 100%, you can put 24% into 100% 4 times. About 2%, 2% in 100% times its years. That's how to think of it, really. How many times can I get the percentage into 100%, and that's my number of years? Does that make sense, Vera? I'm going to move on. has put it nicely. Yeah, exactly. So you 20%, you're fully depreciated in 4 years. And there's jumped on, apparently I'm being told, so I've got to move on. So, to our question here, we can see here now that the carrying value is exceeding the fair value less cost to sell. So looking at 18,750 with 99,500. As soon as that is the case, we end up with an impairment for the difference between the two. So if we now compare 850 and 9,500, the difference between those two, or impairment between those two, is 250. So that's what goes into the PP&E note. Extra depreciation, essentially. Kate, who was sort of, can you go back through that? Are you happy with that now? Where those numbers have come from? Brilliant. Okay. So, look for our held for sale asset. So you guys need to do. So act out what is depreciation in the year, what is the third, and for PP&E note, you need to clear out all accumulated depreciation and to that. So all of our accumulated depreciation and calculated that above 3050, we use all of the depreciation on our debt. So 1,250 need to be removed. The impairment, again calculated above, to be taken out of the note. So a lot of people don't like about the PP note and held for sale are basically putting 9,250 in to at least strip it back out again. But you have to show the shareholders that upon you classifying this as held for sale, ended up with impairment, so you were holding the assets too high, essentially, in the financial statements. Pro forma now. 40,050 being, or 4,500 being deducted. And you might not want to write this on your workbook, but just to sort of prove my point again, essentially this is the bit people don't like. So in goes the impairment. It comes again. And essentially, these should be presented. So you will naturally, in the exam, be putting it in and taking it out as part of removing all associated depreciation on the for sale asset as you are reclassifying it to current assets. Happening here, just so you're all happy, we are debiting current assets $500 accumulated for cost with 1,000. Now, it is not part of the question, but this is just the step of held for sale. Essentially, you are stripping out the asset and including this asset, this non-current asset held for sale will appear in the statement of financial position. Questions on that? Okay. So delete just so that we can rest of the numbers in. You can leave it off, move your numbers around it, but I just want to take it off of mine. The other thing that we need to deal with then is the impairment. Question. So, with impairment, whenever we're doing an impairment review, we're always going to compare carrying value, which is what's in the financial statement, recoverable amount. Now, the recoverable amount is going to be the greater value in use, value to sell. What we've got is the carrying value. Look at point 3 in the question, the cost of the asset, 200,000. If we work out depreciation September and 6, then at that point we would have been charging 1,000. We'd have 2 years. Also needed to look at, it was a property that we're looking at. So the useful life of this was 6 years. So we're going to take off to get a depreciation charge of 8,750. If we work out depreciation for the year ended September 2007, we can put this figure into our depreciation end. So we're doing some of the work as we go on here. So depreciation, we need to do 210,000 by our 50 minus 2 to get 175 value here of 196,875. So that's our carrying value. We want to compare that then, if we go to the question, with the value in use and the fair value less cost to sell. So if we look at the question itself now, we see fair value is 100,000 and the cost to sell would be 5, and value in use is 90. So we're looking at the sort of greater of 2. And that then it's going to come out as fair value less cost to sell. Back to our board, we need to fill in 100,000, so 9,000. We're looking for the greater. So 95 that we compare with 687. Okay. Overall or impairment that we're going to get here is because carrying value is greater than the amount. So 96875 giving us an impairment of 101. And we're going to deal with how we treat this then in part B of the question, which we'll come back to in a moment. So part B, we're going to look at, actually let's do that now. So what we have to think about here, so remember I added on this part B, the question, how do we deal with the loss? So how do we deal with this 101,875? So what I think about here is that when we have an impairment, we need to consider if we have a previous revaluation upwards. In this case, we do, because told we're told that we've got the revaluation, or the only thing that we revalue is land and buildings, and we're told that the workshop had been revalued to 210,000 on the 30th of September 2004. So the workshop has been revalued, and therefore we want to think about reserve to take the investment. Okay, so is what we did in the question of September, or at the 30th of September, sorry. Reviewed. Valued at the 30th of September 2004, we would have been debiting accumulated depreciation, and as part of the SML, what then is you get a credit, a balancing credit to the revaluation reserve, which is equity account. So, cost from 150,000 to 210,000. So we would have debited by 6. We need to work out how much accumulated depreciation we had at the 30th of the 2004. So essentially, before we valued, we were depreciating an amount of 150,000 in 2, so we're depreciating it for 2 years out of 50. So on the 30th of September 2004, for 2 years, essentially. 2 years, and then accumulated depreciation being added back, 1,000. Going into the revaluation reserve, then the balancing figure was 66,000. Can anyone tell me in the chat panel what happens when we have a revaluation? What do we do to make sure the shareholders aren't annoyed that we've got more depreciation going through the financial statements? Surplus to retained earnings. Brilliant, Ali. Brilliant, Andreas. Yeah, excellent. So what we need to do, we need to transfer the surplus. And so for 3 years, 2004 to 2007, we're doing the reserve transfer. Transfer, it's an annual transfer. Looking at what would have been depreciation, the revaluation. So the revaluation, the would have been 150,000 divided by 50 years, as we saw noted above. Valuation. As previously, it shot up to 210,000 and remaining useful life at that date of 8 years. So essentially, what we're left with is depreciation of 1,375 per annum. We just mentioned for 3 years. So we multiply that by 3 and appreciate then debiting the revaluation reserve, crediting retained earnings, 1,375 times 3, so 412. Because it's between 2004 and 2007. So we did once in 2004, once in 2005, once in 2006, once up in 2007. Okay, so what we need to think about is at the 5th of September, the impairment, what the valuation started off forward with in 66,000 or now depreciation. So the valuation reserve is now at 6,185. So we need to get the revaluation reserve credit value of the asset 101,875, have a balancing debit into the income statement of 40,000. Okay, so that was part B. The only thing we see in the PP&E note then is the 875 figure before we calculate the addition charge. Pause in case I'm writing that down. So 1. for 15 marks.